That's Bob Iacchino. Before I introduce our guests, I want to do some housekeeping. First of all, thank you guys for joining us. Particularly, I love that we took this show live, and I love the live interactions you guys give. Thank you very much for that. Also, our sponsor, Independence Arc Foods. We always complain about how huge food conglomerates are dominating the food source, and not in a good way. There is something we can do about it. Marco from Independence Arc will set you up with grass-fed, grass-finished beef. It is unbelievable, and he's adding in pork and Wagyu in the next coming months. So we're very, very excited about that. We have Nathan Powell. We talk a lot about AI on this show. By the way, we're not alone. I know everyone talks a lot about AI, but we think it's a very, very interesting, not just an investment theme, but about what it's doing and then how from that knowledge, figuring out where the investments will be. We have Nathan Powell, who is the president and founder of Deep Market Making Inc. How are you, Nathan?
Great. Thanks for having me.
Could you tell us a little bit about your background first?
Yeah, I spent most of my career in the technology industry. For example, I was at Microsoft for a long time, and there I was doing machine learning and data science for the search engine. But I think the biggest takeaway for me was just spending time with the Microsoft researchers, learning about the early stages of deep learning all the way back in 2012. This is when, we've been doing AI for a long time. And finally, with deep learning, we were starting to have models that were actually really accurate, starting to have something that looked like it could approach human level accuracy on some simple tasks like, image recognition, if you remember. And so you went from models that were maybe 70% accurate to 90 something percent accurate in one big step. And then I got to apply it with some like earlier language models with Bing. Question answering. You have a simple question on Bing, and we often have the databases or direct data to answer that question. And so it was a matter of translating that question into a machine question, and then looking at the answer and displaying it right there on the search engine. So now that sounds like nothing, right?
Yeah,
But
but at the
back then it
time,
was
it's a big
yeah,
deal.
yeah,
Yeah.
yeah. This is
So
back in like 2015 to 17 ish.
yeah, Bobby.
and
Yeah.
and
So
so then I also got a chance to help Bing raise their revenue by over $100 million on a team that was also doing a lot of revenue raising. And I got interested in economics, finance, and I worked with Susan Athey, who's a chief consulting economist, or was a chief consulting economist of Microsoft at the time, and thought, like a lot of this stuff could be applied to finance, deep learning specifically. And so I started looking for a job where they would actually want me to apply deep learning to that. And it actually was tough back in 2016 or 17, finding anybody who wanted to do that, wanted to invest in an employee to do that. I did finally find a role with JP Morgan to do that. And so then I did a bond pricing model that in 6 months beat everything that the quants had done previous to that. And it went to production, estimated impact of $50 million. So that was awesome. So then that resulted in like eventually, this company where we're trying to do that for the entire industry, and not only corporate bonds, but we think that we can create the open AI for finance, where instead of predicting the next word, you're predicting the probability of the next financial event, however you want to define that financial event. So it's all about taking what we've learned in the technology industry and applying it in the finance. And I don't know, it's always surprising to me how far behind we are in the financial industry in adopting deep learning, actually, compared to what I was used to in tech.
So Nathan, how would you say this is going to work from like the 30,000 foot view? Jim and I both were on the trading floor back when the swap traders, right, were going back and forth between futures and cash, and they were making money off of the small spread between the future strip and the cash swap market, right? And as they traded it, that spread got smaller and smaller and smaller and smaller until it basically disappeared for the most part. If you have AI predicting things, is there a risk of AI predicting to everyone at the same time the exact same thing, therefore sort of eliminating the edge of the AI in the first place? Is that, or am I just oversimplifying that?
Oh, that's a great question. Actually, we get a lot of people asking us a similar question as to like, will our edge go away once everybody has adopted the technology? And um, that's sort of true, but it's also something that ends up being actually a self-fulfilling prophecy, because if everybody is looking at that signal, then it makes it more likely that the price will land on where the signal says it should be. And so then the signal's still valuable to have just as an informational piece, even if you think you have an edge over it or want to have an edge over it, you still need to be looking at where the signal's saying it is. If that makes sense.
So here's my question: is that, well, it's more of a request for you to explain, because the name of your company is called Deep Market Making. So my assumption is that your AI models predicted where the exact price of a bond should be, for instance, and then just gave a bid ask that you can make money on. And I assume that's part of it. But is there also a directional, like a speculative model to judging that asset and making and creating a position on it?
So we haven't created an alpha generating model yet, but that's on our roadmap. And I think a lot of the same, or pretty much 95% of the infrastructure that we already have can be reused for the alpha model, because it's the same kind of inputs that you need for predicting the price as it is right now, or where it's going to trade like the next second versus some amount of time into the future. That, all it is like a change in the label of the model or what you're asking it to predict. And then it can learn, okay, what are the probabilities? And usually, you're going to have a confidence interval that as you go, further into the future, it's going to widen out. But it might widen out biased in one direction or another. And just having, some insight into how fast it widens out is useful, I think, for traders.
So like, okay, so this could eventually replace traders as well. Whatever. What I'm saying is you could put in inputs, not just, like our model at Path Trading with 8 and 21 exponential moving averages and 50 and 200 simple, that one of them, along with about 6 other different technical parameters we use. Not only could you program all into the AI model, but have them ascertain which one is working best at certain times and shift on the fly. That's all 100% possible, correct?
I would say it's possible to automate everything that we have currently or that a trader has currently. But I think the place of the human is to be looking like at the boundary, like if I think of like a bubble as containing all of human knowledge, um, and then the humans kind of exist on that boundary, where you're trying to find what is the additional piece of information that the model's not taking into account or that other people aren't looking at that can give you an edge. And I think there's always going to be that edge of that bubble. Whereas, yeah, the AI can take care of all the old stuff or the existing human knowledge, but there's always more knowledge to accumulate, and that's, I think, where the human trader will always have a role.
So are you saying it's more about the question that we ask the model than it is about the model? Is that what you mean by the outside of the bubble, the question that you're asking? Like I could say, when is the next catastrophe in credit markets, right? And Jim could say, when is the next catastrophe in credit markets that involves over leveraged companies? And those would be two separate questions. And maybe Jim's questions generates an alpha generating answer. Am I doing that correctly?
Yeah, I think you're right, because yeah, as long as you can hedge the risk of the other, like if you can isolate that variable and hedge out the rest of the risk, I don't see why you couldn't have an edge if you have an insight on that piece of information. Yeah.
So I have something happening right now, and it's a mutual friend of ours, Nathan, yours and mine, that Jim will meet when he comes down here. This friend of ours does really want to meet Jim when he comes to visit, and he's currently coding something for me. And when I talk about him, he's just a generous guy. When I talk about him, when I tell him some of the things I'm doing, because he's in our industry as well, I think you know who I'm talking about, Nathan. It's the person that introduced us. When we talk about, or when I talk to him about, some of the things that I look at, he says, "Oh, I could totally build, machine learning for that and help you modify it and tweak it and so on." So I give him parameters, and he comes back with models. And then he decided to combine two of the models that I hesitate to call them models because it's the stuff that I look at, right? It's not in the form of a model at this particular point. So, it's like I don't know. I don't want to make that comparison, but to call it a model right now is a stretch for me. But then he programs things. And he says, "Okay, run this and see how it goes." And a couple of days later, he comes to me and goes, "I'm comparing one of your models against the other, and I might have generated something completely new that's better than both your models individually." is this the kind of thing down the road? Is this the direction it's going to go in? Because to me, when you talk about AI and trading, I think about AI and pretty much anything else and how it's going to eliminate jobs, not necessarily augment the people who perhaps have developed a particular skill set during the time. So you're telling me I'm wrong on that, right? It's going to eliminate fringe jobs, but it's not going to eliminate people like me and Jim. And I'm not afraid of it. I mean, it is what it is. You know, the world is what it is.
Well, I think it depends on how you define the job. So, like, if you define the job as doing what you're doing today, then maybe that job gets eliminated. But if we're flexible in how we define the job of the trader to be maybe a little bit higher, 30,000 foot view, rather than like in the weeds view that we've maybe had in the past, to where you need to be like maybe the AI can help interpret like the low level information, the little nuts and bolts of the data feeds, but then can give you a more summarized view so that you can draw insight and pull in again extra information. And I think also it has to do a lot with defining the objectives. Like as a trader, you don't just have like at least in the short term, maybe your long term view is like risk adjusted P&L. But even then with risk adjusted P&L, people have different risk preferences. So that in and of itself, that's a curve, where you are in risk versus return. And so you have to decide where you're going to operate. Now, there's probably a lot of other variables like how much, maybe like daily VAR is something that you care about rather than just overall annual risk or something. So there's so many variables that could define how well you're performing as a trader at any institution or individually. That means that every trader gets to define that for themselves. And if AI is part of optimizing towards those objectives, you still need somebody to decide what the objectives are.
Oh, that's a great point. So tell me this. Tell me what your plan is. You build this model. You've built this company. You
Yep.
want your clients to be bank bond desks. Is that about right?
We sort of started with the sell side. I came out of the sell side, being at JP Morgan before. So I kind of had that view. That's why it's called market making combined with deep, as in deep learning. And yeah, certainly they get a ton of value from this technology because they're the ones that need to set the prices, send out indicative prices, negotiate prices. So yeah, prices are number one for them. But it's also very useful for all the buy side participants, like all the hedge funds, all the um, pro or semi pro traders, family offices. So there's really a lot to do here with bonds. And so yeah, I would say it's actually useful for a lot of different players.
So tell me how this, because I know if I can read you right, this starts with bonds, and I think bonds are interesting. Bonds are fascinating to me. How does this then morph into something to for currencies or for even equities as well? To how to make markets, how to even predict directions.
Yeah, so right now our model's pretty specific to corporate bonds, and it does a great job with it. It's the most accurate, so that's great. But really, to be the OpenAI for finance, that means it has to work for kind of everything. I mean, that's what OpenAI. It doesn't just work for poetry and not just prose. It's everything. And so we need to come up with a model that can learn to predict prices or financial events in general, the probability of financial events in general, for all the asset classes. And we started with one, and then the next step is to have two, and probably the second one will be highly related to corporate bonds. But the idea is that we have to come up with a newly defined data format that goes into the model that where that data format can both define what inputs you want the model to use to determine the probability of the financial event, as well as defining what the event is that it's supposed to predict, and then train it on billions of examples. Um, and the idea is that you want to create a model that can outperform any model that's only trained on one asset class. So I want to create a model that outperforms our corporate bond pricing model that's only trained on corporate bonds because it's learned some things about mortgage-backed securities, munis, FX, equity options, and it's learned to apply that event data, which is the input for the model, all the recent financial events that we want to give it, and generalize to say, okay, well, given these events and given what I've seen in the past, that how the correlations work and how you've defined their relationships with each other, then it can extrapolate maybe even to an asset class that's never seen and do something at least reasonable. You know?
So I'm going to switch real quick to general AI questions because AI at the same time excites the hell out of me. I've made good money on the trade, but it also terrifies me as well because I think the ground is shifting at a very, very rapid pace.
Yeah.
So my thesis on AI too is, and so everyone, you guys who are watching know what I'm going to say, and I want to know what Nathan's opinion on it. I believe that AI, we're more entrenched in an AI world than we even know it. It's one thing when B of A brags about getting rid of a lot of HR people because they're adopting AI. But it's another thing. Small law offices, accounting firms, writers, things like that are using AI, but they're not talking about it very openly because in some way it makes them feel more threatened about their current employment. Do you agree with that thesis?
Oh yeah, I mean AI is way more pervasive than people realize. Like, I mean,
That's what I thought. Right.
yeah, yeah,
It's
totally agree
crazy.
with that
And are you
because
scared of it too, or just excited
no,
about it?
no, I mean, I think we need to plan for it. We need to project a little bit into the future. Where I'm a big fan of Ray Kurzweil, who has done a great job of actually mapping out the future, and he's been pretty accurate. He's the most accurate futurist that I've ever heard of, and I think the key is to have like exponential thinking, because I think most people, he says most people think linearly, and you really have to think exponentially. Like the power of these AI models is going to go up exponentially because computing keeps improving exponentially, and the AI models themselves, like the algorithms that we're using to train them, keeps improving exponentially. And so, if we want to if if we want to prepare for the future, we need to not plan for the model to get or for the AIs to get 10% better in 3 years, but like maybe 5 times better.
Sorry, I muted myself. So I'm still having a hard time grasping. I'm with you guys on this. Like, for example, you hear a lot of, let's talk about creatives like actors and actresses in Hollywood. I forget there's an AI actress out there now that's actually doing shows and movies. I forget what her name is. Nathan, maybe you know it. I can look her
I don't
up
remember either,
next
but
time
I
Jimmy's
know what you're
asking
talking
the
about. Yeah.
questions. But she is actually starring in features right now. And she's good. Like, she's really, really good. And there's a lot of people on Twitter and I'm sorry, X and other social media platforms trolling celebrities by saying that this particular AI creation is their favorite celebrity right now. It's their favorite actor. It's got to have supposedly like a 500,000 followers on each of the different platforms
Yeah.
already. And this is the kind of thing I think that scares people. And when I look at from my perspective, I'm an older guy, I'm somewhat established. I have my businesses that I can add AI to. But what do you tell people that are younger now and are saying, well, as a matter of fact, I have one specific nephew who says things to me like, what's the point? Right now, what's the point? Like, what am I supposed to be studying for? I did X, Y, and Z in school, and that's already being eliminated. So what's the point? What advice do you give people like that? You're knee deep in it. So what do you tell them when they ask you those questions, if they do?
Yeah, to be honest, I've been trying to figure that out myself because I do think that our education system needs some adjustment to the reality. Is that maybe your job isn't going to be learning a bunch of information and be able to recall that, and that's your job. Like that's kind of the job of a diagnostician. And now we're seeing models that can outperform, like the average doctor in terms of being able to accurately diagnose illnesses. So maybe that's not your job anymore. Maybe your job is maybe I'm starting to think the main job going forward is going to be entrepreneur, like trying to find a niche that's not being served, and it's not being served not because the AIs aren't smart enough to theoretically do it. It's because the rules that they're under by whoever set them up don't allow the thinking that is necessary to address that need. And so that's the job of the entrepreneur in general, is to find a need that's not being served. And if AIs are so good at automating something that has already been figured out that can be served profitably, then I think the job of the human becomes more finding those opportunities and then mapping it to a set of tasks that the AIs are allowed to do. You know, and I think a lot of it um, will be helped by sort of liberalization of our kind of economic structure. Like right now, there's so many regulations on the books in the United States and a lot of other countries that kind of constrain everybody's thinking. And so if you have AIs that are like, oh, I have to be compliant to every single word of the U.S. code, it's not going to be able to do much. You'll have to have a human that has the agency to break some rules to try something new out, and that's probably true in most places. But I think I suppose as more of the economy moves to like sort of cryptocurrency, smart contract territory, then that'll also allow more freedom of experimentation. But I think it's mostly about the humans provide the will and sort of the resource allocation to what they want. That's really what you're going to be doing. And so, yeah, just being thinking that you're going to be okay to be just continuing to do the same job that might be automatable. That that's not the path I would recommend. I would recommend trying to become an entrepreneur.
So when you talked about the education system and how it sort of needs to retool itself to accept this reality of AI. I find it harder and harder to do 2 times 3 is 6 because I just don't think about that anymore. Oftentimes, I don't know if either one of you guys have found me doing this. Obviously, my use of AI is very base and very simple. I'll write an email and I'll go, I don't even think I even understand what I was saying in that email. So I copy and paste exactly what it was into ChatGPT or Grok or Claude or
Yeah.
Perplexity. And I go, rewrite this so it makes sense, please. And I always say please to AI. I don't know why. And then it spits out the email. I'm like, yeah, that's what I was trying to say. So I find myself less and less able to communicate electronically without the help of the AI. Does this concern either one of you? That you really have to take like the next generation of kids, the kids who are 3 and 4 and 5 years old, and go, don't worry about 3 times 3 is 9 anymore. Don't even worry about it. Okay. It's not important because you can ask your phone and find it out. As like older guys, I know Jim and I sort of ethically are worried about it, but does it actually matter in the real world?
Can I take it first, Nathan?
Yeah.
Because I'm worried about it. You know, after raising 2 kids. Nathan, do you have children or no?
I have 3. Yeah, I have a
Yeah. So
6-year-old.
I raised kids.
11.
Right. Very nice. You're in the thick of it. My kids are adults. But anyway, so seeing what technology did to particularly the young men of a generation with addictive things like video games always, and even social media, which plays on dopamine, with neuroscientists being hired by Instagram and shit, and they're just totally being bombarded with this. I don't think it did a great thing for a generation of young men. And I'm someone who has always been my whole life learned that everyone worries about technology when it's coming in, and technology almost exclusively makes things better. I am not certain that the smartphone in the hands of 12-year-olds and 14-year-olds, that technology jump was good. As a matter of fact, I think it harmed a generation. Do you think, one, that that's true, Nathan, when you take the question? And two, is this something to worry about with AI as well, in the way Bobby posed the question?
I think it's a two-edged sword. Yeah, you can be like, I don't have like my 11-year-old. She still doesn't have a smartphone because I'm
Good.
I'm concerned
for
about
you.
the amount of screen time. I'm concerned about social media to some degree. I think it would make sense for her to get a little bit older before, so that she doesn't just natively have like an addictive pathway to this stuff. But so I see it that way. But I also see it as like, you have to, as a species, we kind of have to adapt to the changing environment somehow.
Yeah.
And one issue is that the birth rate is so low that that's an indication that most of us are not that well adapted to the realities. Like, we're, for whatever reason, we're prioritizing other stuff than having kids. A lot of people don't have any kids, and
Who's
and
prioritizing doing something other than having sex? To me, that amazes me. It's literally the thing that's driven empires for thousands and thousands of years. But all of a sudden, it seems like they're not as interested in that. I mentor kids all the time, like, we don't date I'm not really dating. What does that even mean? I don't get it at all. Is something happening? Is there something in the water?
Yeah, That's one thing you can't automate.
I saw the
Yeah, you
girl
can't
who
automate text,
started.
Bobby.
Yeah.
Who's the girl that started in all the Harry Potter movies as Hermione or whatever the hell
Oh
her
yeah.
name was? She
Yeah.
Kelly
announced today
Kissel,
that
right?
she has self-partnered, and
Okay.
I'm like,
Oh, good for her.
so that means you're alone, right? That just means you're alone. And this is this weird thing that's come up with. Like I've asked some pretty messed up questions to AI in the past, and again, we're not talking about AI with markets, and we should. But I've asked them some pretty messed up things, and I haven't really understood the answer. I'm like, what? Are you, I've gotten into arguments with AI. Nathan? I don't know if you're done answering my last question, but do you see that going away at some point?
Can I
Because
make
I
a
can
quick
find
comment on the
it's obviously
self-partnering
early
thing?
in the process, right?
Like
But I want to talk about the self-partnering thing real quick because we as men have self-partnered many times. There are those who admit to self-partnering and liars. Anyway, Nathan, you
No,
can
I
answer the question.
self-partnered just this morning. Go ahead.
yeah, it's incredibly common, right?
Oh,
We
yeah,
went
here we
off
are.
topic.
Nathan's like, oh shit. Why did I say yes to this? Okay, go on, Nathan.
Yeah, I mean, what was your question? Going back to what
My
it was.
question was, I find AI being wrong all the time, and I think that's one of the
Oh,
things that scares me about using AI in markets. Now, I'm wrong on my own enough. You know,
right.
I don't need AI to give me a wrong signal of sorts.
Well, the way to think about like an LLM is that it represents sort of the like it has some random variation in it. Like it's not always going to say the same thing because it's randomly selecting each next word that it generates, right? But it but like the probability that it's going to generate each word has to do with what the median piece of data that it's seeing has said, or either the mean or the median, depending on its loss function or its optimization algorithm. And so, to the degree that what's out there on the internet is correct, it will probably mostly reflect that. But there's a lot of tons of stuff on the internet that's wrong. So of
Yeah,
course it's going to be wrong a lot of the time. And
yeah.
I'm going to disagree with AI all the time.
So I want to say something real quick. Jimmy talked about Independence Arc Farms is one of our sponsors, and Jimmy, I think we forget to mention the discount code that we get from Marco at Independence Arc, which is FU. If you're calling him, say you found him from the Finance Unfiltered podcast, Futures Edge Finance Unfiltered. If you're ordering online, FU gets you a 10% discount. I wanted to mention that because I got a call this morning from a friend saying, hey, someone's trying to buy, but they don't remember the discount code. So I wanted to make sure I put that in there. Second thing, we are also sponsored by ourselves, theunfilteredinvestor.com. And Jim and I get a lot of messages after each episode. People will say, hey, that was great. You talked about this idea, you talked about that idea, but how do I actually trade this stuff? It's exactly why we built the Unfiltered Investor. At this point, it is not AI driven. I'm starting to get through Nathan that it could be and it may be in the future, but currently it is not. It's where we take everything we talk about on this podcast and turn them into real trackable, actionable trading ideas. Every setup is time stamped, transparent, based on the same process that we actually use when real money's on the line, and the results speak for themselves. Right now, we're running at about a 74% win rate since we started the newsletter. That's pretty good. The reward to risk is usually 1-to-1 or better. We try to keep it there, Nathan, as you're pretty good at math, I'm sure. If you have a win rate of about 74% and you're at least 1-to-1 reward to risk, you're probably doing pretty good.
Yeah.
We release the newsletter each week, get you the trades we're watching, the stuff we're looking at in the future, the levels that matter. And then Jim and I will be doing short market videos. We haven't started that yet, but we will, where we're just basically saying what interests us in the coming weeks or from the past newsletter. It's not theory, it's actionable intel. You kind of get inside our heads to see what we're doing. So if you've been listening and wondering what we're actually trading, you can find it at theunfilteredinvestor.com. That's theunfilteredinvestor.com. Go there now, see what's moving the markets before the rest of the street does, or at least we think we're ahead of the rest of the street. Jim, we talked about gold, and then like a year and a half later, Goldman Sachs got on the trade. Maybe they subscribe, maybe they don't. I don't really know.
By the way, so Goldman Sachs and Morgan Stanley, or was it JP Morgan? They both got on the gold train about 1.5 to 2 years after we had been preaching it, which, by the way, that's great for them. They're usually way more than 2 years late on this bullshit. So well to go. Way to go. And by the way, back to what Bobby said about influencer investor, these trades are literally in real time that Bobby and Mike do. I write about fundamentals and about macro, but their trades are amazing. But Nathan, let's branch into what sectors do you think are going to benefit the most from AI, or is it just a blanketing? And like, because I just in my head goes, mining, AI is going to control different things. Even retail, AI is going to control a bunch of things. Where are the ways to put our money to work here?
Yeah, and we're talking about outside of tech itself, of course, right? Because obviously Nvidia is going to benefit whatnot. But
Yeah, yes, definitely
well,
outside of tech
I
itself.
think I'm biased, obviously, but I think the biggest one that's like sort of untapped when it comes to AI is finance, because there is a philosophical difference between what I grew up with in the technology industry and the way that quants think. So quantitative researchers, they, at the big banks, and it's different when you get down to like the Columbia University students and see what they think. They're all on board AI. They're thinking about it all day long. But when you talk to like more established quants in the field, they were educated at a time when it was all about differential equations, where I prove that my differential equation is a good model for this financial system under these simplifying assumptions. And the problem is obviously, well, there's multiple problems with this. The main problem is that those simplifying assumptions are absolutely not true, and everybody knows it. But they have to make those simplifying assumptions because otherwise, the problem is not simple enough to solve with a differential equation. And two, that yeah, the differential equation tries to reduce a vast group of people into an equation, and that's just too simple to really model it as well as even a human trader. Like a human trader is a vast neural network, so you can do better as a human to understand how to price a bond or something than a little differential equation, generally speaking. I mean, yeah, some people say, well, I should,
So that's interesting.
yeah.
But I was going to say is, so when I hear that, I'm hearing the big banks more than the regional banks, whose business model is a lot more simple, probably, than Bank of America. Is that accurate to say that you're talking more about the big banks really being a beneficiary?
Um, no, I think everybody's going to benefit. Yeah, I guess. I mean, I guess some will benefit faster than others. I mean, the big banks, since they have concentrated, piles of capital, they might benefit first from the new technology. I mean, JP Morgan that I was at, they were one of the early adopters for AI or deep learning. Jamie Dimon said recently that they're spending $2 billion a year on AI and getting about $2 billion of benefit. But I think that's even kind of small compared to what I think they should do coming out of a place like
Yeah.
Microsoft, where it's way bigger than that.
Right.
I think
But if he's saying he's already spent 2 billion, he's getting 2 billion back right at the beginning of this. That is pretty amazing, because I cannot think of another technology that there wasn't a huge build out and expense before it ever started paying even the slightest dividend. So if it's paying dividends already, this seems like a pretty powerful thing. Bobby, do you agree with that?
you're muted.
Say something. Nathan, were you going to say something, or did I just cut you off?
Oh, I was just going to say, well, JP Morgan at least was investing in deep learning by the time I got there in 2017. So it has been a little bit of time. But yeah, so I agree. It's still in very much the early phases in terms of
Yeah,
adopting AI.
there's a lot of news stories out there, Nathan, about how companies like JP Morgan specifically, maybe not them specifically, but that they're spending money on AI, but they're not getting the ROI or anywhere close yet. Do you disagree with that, or do you just think they know it's more of a long game?
I think a lot of people lack the ability to measure results in a scientific way. Like, and I even saw that in at JP Morgan. I like sometimes. I mean, I think most like tons of people are brilliant and they know how to measure it and everything. But I saw one project where they were going out to the world with these supposedly amazing results, and then I started asking them questions. Well, how did you compare the result to your baseline? And it turned out it was just not it was not a true A/B test. It was very it's kind of like um, when you say, okay, so a bunch like if you say, oh, there's more people that die if they're near a golf course or something. Well, who hangs out at a golf course?
Alligators.
Yeah, it's like, and so I think one thing that has helped us is that I just kind of got an education at Microsoft and how to run an A/B test, and it turns out it's actually not as straightforward as you would always assume to do an A/B to do a proper A/B test, especially when you are trying to do something a little bit more advanced than the obvious. Oh, I have a treatment and control. It turns out it's so easy to misinterpret the results and make the wrong choice. So I think that's part of what's missing for a lot of people is that they may have this idea on how to train a neural network and measure results, but they don't know how to um, know whether see for sure whether it's actually better than what you had before.
All right, so give me a just like lay out an example of how a bond trading desk would use your product. Tell me they're comparing X versus Y, and they ask your particular product this question. How would it actually work?
Yeah, so there's a lot of different use cases. One of them is when the dealer is responding to a request for quote, because bonds are traded over the counter for
Right.
the most part, and so you have to go to a dealer typically, and so you send the dealer a request for quote, and then the dealer says, so if it goes to a human trader, they have to respond fairly quickly to be competitive, or if it goes to an algo, the algo has to do a good job of coming up with a price to quote. And there's a lot of things that go into that price. Now, one of them is can be our model, where our model says the probability of you getting filled on this RFQ if you quote different prices. But the other components have to do with your objectives. Like, how much do I want to do this trade? Is this a risk decreasing trade or a risk increasing trade? Do I like this client, or have they, or have I kind of had adverse selection or something with this client? Do I want more market share, or do I care more about P&L today? Do I care more about risk or return today? Like all these things have to kind of go into, well, how much do I want this trade at different prices? And then if you can combine those objectives with the probability, then that gives you a quote, like an optimal quote under your objectives. So that's one use case. Another one is that the dealers have to send out runs every day or maybe multiple times a day. Those are just like indicative quotes to send out to their clients saying, hey, I'm in the business for this bond. Here's kind of my rough price. They're not held to these prices. It's not like submitting to a limit order book. It's just like saying, hey, I'm willing to price, around here unless something changes. So, but if you're totally off market, then people are going to see that and kind of ignore you, and you're not going to get
Yeah.
the volume. Or if
That, what,
you're bad, if your price is bad such that you're going to lose money, they'll come right away to you. You'll do the trade and you'll lose money, right? So
Right.
Oh,
it's
we've
one or
seen
the other.
that before.
Yeah,
What something you just said, Nathan, that really struck me as fascinating. Because when I get a deal that comes to me in SOFR, the 3 month futures,
yeah,
and I bring that to call it 10 different market makers who then compete to make me the best market, and I pick one. But sometimes my three best, if they lag by a half second or lag by a full second, I'll still cut them in on the deal because they're my best market makers and they have
sure.
been long term. And the point is that it's not like you can in the past you just whoever comes in first is how you'd model it. Now you can actually make it to preferences, and I think that's unbelievable. Can you expand on that a little more? Because I'm amazed by it.
Yeah, I mean, I think it's. I think more people need to think about the problem as like a multi-objective optimization problem, where you, as I was talking about earlier in the chat, you even if you just have two different objectives, it's not always known like how you should balance them. Like there might not be like a monetary trade-off like between each level of risk and each level of return or each. So so what you do under multi-objective optimization, like from a computational standpoint, is you try to simulate your different options and say, okay, this combination of parameters in my objective function are going to give me this combination of outputs in my simulation, let's say, in my backtest, whatever it is. And then you, as a human operator, as a trader, gets to pick where you want to operate out of all those choices. And with multi-objective optimization, you still get rid of a lot of options. Like most of the options are not very good because the options that are good are at least good on at least one of the metrics, and then there's some trade-off with all the other objectives that you have. And I don't hear a lot of people talking about that enough, because I think a lot of people just assume that you can optimize to one metric and everything's going to be happy. But the thing is the objectives of the traders changes every single day or multiple times a day, depending on what's going on. And you have to have a system that can adjust for that. And that's why I didn't take a reinforcement learning approach, where you train a model to optimize some objective function, because the problem with that is the objective function is going to change. You won't have to retrain your model every time the trader's objectives change.
At the end of the day, though, their objective is to make money, though, right? I mean, that's never really going to change. Or are you talking about some of all the other objectives that you put in before, where it's just somebody you like, blah blah blah?
Yeah, I mean, like at the end of the day, like if the only thing you were measuring is like how much money am I going to have them make a year from now, that could seem like a single objective. However, it's not really in practice really true, because like, would you be okay if the path to get there where your bank account is going up and down like a cliff in a valley over and over again, and you just happen to get lucky and got there, versus having a nice steady climb up to that number, which
Yeah.
most people would rather have it. So
Yeah, the steady climb is where most people fall in.
Yeah.
That's interesting to me. So on the overall AI side of things, can you envision a world where AI never gets past the point of helping humans live a better life? And you know where I'm going with this, right? There's a lot of people out there that believe that, a self-thinking machine eventually will realize that we could kill them by unplugging them, and they'll find a way around that. I know this is a weird question. I'm sure you get it.
Yeah.
There are so many people that are afraid of AI, the same type of people that are afraid of crypto for some of the same reasons. I assume you have at least a passing positive view of crypto. So can you touch on all of those fears that people have?
Yeah.
I don't know if that fear exists in the bond trading world. Maybe it doesn't.
Well, definitely we run into people that they don't want to look at an automated pricing source because they'll say, I know what the price is. And I think that's coming from a place of fear of saying, I don't want to be replaced, so I don't want to look at this other thing. But yeah, I mean, I think like the doomsday scenario that people bring up of like misalignment, where you have an AI that decides to turn the world into paper clips because it was told to build as many paper clips as it possibly could.
Yeah.
And whoever set that up didn't assume that it would be able to turn the earth into paper clips, right? I think so. A lot of people talk about regulation of AI to try to prevent misalignment problems. And the problem with that I see is that if you have regulation about the objective function that AIs are allowed to optimize towards, then you'll have, within that jurisdiction that's regulating it, you'll have all the AIs with the same vulnerabilities in their objective function, so that if they go bad, they might all go bad at the same time under similar conditions, right? And so, like, I actually think that kind of regulation would increase the probability of like mass problems, versus just letting there be a diversity of objectives set by billions of different people.
Hmm.
Because in a more diverse scenario of AIs, if one of them goes rogue, then you can elicit the assistance of the AIs that are not rogue to fix the problem, and it's not going to be a scenario where there's like one big AI that's like the master of the world, unless we specifically design the world that way. But I don't see that as a future. I think it's just going to be billions of different variations that people build to optimize whatever they're trying to do.
That's sort of
So our friend,
I'm sorry, Jimmy. That's sort of the theme of the Iron Man movie, that James Spader played the bad robot, and the good robot ended up beating the bad robot. I remember it was Ultra.
Yeah.
I can't remember. It's not important. I'll remember before we hang up.
no, more importantly, you watch superhero movies, Bobby?
I love them. I love them.
Yeah, me too.
Do you really? Nathan,
Yeah.
do you watch superhero movies?
Yeah, I mean, I'm not like a super comic book person, but yeah.
I was a comic book kid,
So-
Jimmy.
Did you guys, either of you guys, read Scott Nation's book, The History of the United States in Five Crashes?
No, I
I
can't
don't
read
really.
books of people I know.
Oh, so yep, Scott's book is excellent. And
Mhm.
one thing that he, by the way, I'm so sorry I'm having technological problems. My internet says I have rocket fast speed, and I still see there's a delay. And I apologize to all you people if it's cumbersome. But his contention is that before every crash in the United States, there's been a new financial contraption that draws everybody in. And you're saying that you don't believe this could be it because you believe each model will be so diverse and different than the other, and they'll all be independent, correct?
Yeah, I mean, and I don't see like AI as being like this. Like, does he include in his definition of financial contraption like technology advances, or is he more talking about things like?
It's exclusively technology, a
Oh,
technology that he views as different and new.
oh, okay, okay. Yeah, so like, so you would probably include in that, like, obviously the .com bust, and was there something before the '89 crash or '87 crash or?
Yeah, there was something similar to that in crashes for 100 years. Like even 87, it was those protected portfolios that had stops built in. I don't know if you know much about the 87 crash. And even going back hundreds of years, there was different technological advancements.
Yeah, and so in '08 would that just be MBSs, or would that be, or like the, or like the credit default swaps the way they were set up, or?
I think there were the credit default swap is what he went into, but I can't remember it quite honestly. But the question, I guess, is that is there potential for such an alignment of a bunch of AI models if they all gravitate towards one thing, get at one side of the boat and crack the whole thing wide open?
Well, I think there will be bubbles, or there are bubbles maybe, in AI technology or AI companies where you have price earnings, ratios that are like astronomical, and will they ever be more profitable than just doing a value index or something like that? Yeah, that remains to be seen. It's always tough to predict. I mean, because like one interesting thing is like in the .com era, like a lot of the companies that went bust were unprofitable, and were booming before that. But this time it seems like so much of the market cap is concentrated in companies that are profitable. It's just that they're at trading at such high levels, right? That it's a little bit ridiculous. Um, well, and the other aspect is like crypto. So crypto, that might be viewed like as another financial technology, right? So, and I've often thought that AI and crypto like, sort of needs to converge. Like, and there's a lot of interesting things that can be done in the convergence. I mean, one of the things in my field is that real world asset tokens. In order to be able to track real world assets, you need like an AI to fill in the blanks on the price, so that it can be settled when you have somebody backing a real world asset token. So that's another idea that's interesting. But like, I also think that cryptocurrencies could sort of like result in what I almost want to call like a digital life, where you have like a smart contract that almost acts like an organism in an ecosystem, where it's providing some value to the market by how it's programmed. And it could even have like offspring where it's programmed to like make a copy of itself that's slightly mutated, so that it can evolve over time, and then you know and be sort of autonomous. And like before smart contracts were on board, it's hard to imagine something like that existing. But now that we have something that can sort of autonomously do financial transactions, in theory it seems like it could exist. It's just a matter of, does it have enough computational ability and data storage to really be viable as an independent thing for very long, and to be competitive with humans that are trying to provide value as well. So I think that'll be interesting.
It's Avengers Age of Ultron.
Yeah.
It was a bad robot that was eventually beaten by the good robot. The bad robot was smarter in the beginning. Then the good robot became the vision.
Yeah.
Never mind. It's a whole
Yeah.
thing. Um,
Well, and I think what that story misses is that it was okay. So there were just two robots fighting each other, but I think, but it's we actually could have millions of other robots helping on the good side, or and maybe on the bad too. But like, I think overall you'd have a lot more on the good side, because I think most humans don't want to be destroyed. So
I'd
although
like to
there are
watch
some,
that fight from my beach house in Belize, quite
yeah,
frankly. That's where
yeah,
I'd like to be watching it from.
oh yeah,
Um, The last question for me is how do people, like our audience, likely can't get too much benefit from your product? Is that correct to say? Because you're more going for the institutional side.
Well, that's been our focus initially, but actually
We do have institutional viewers, just
Yeah.
for the heads up. But
we have a new free website called bonds.deepmm.com, and you can get a 1 hour delayed price. And then we're going to be rolling out more of a retail version of our product that has different pricing tiers. One of them is the lowest one is going to be $99 a month, where you have like the same thing as what's on bonds.deepmm.com, but it's non-delayed. And then some higher tiers gives you more data, like once you're paying $500 a month, then you can get the Finner Trace feed as well, which shows you the actual bond trades that have happened for that particular bond on top of our model's prediction. But in the meantime, yeah. So while we're rolling that out, I think you can already take advantage. And if anybody has any websites where you are trying to display information about bonds and want to embed like a pricing graph of that's relatively up to date. I mean, 1 hour delayed is actually better than most quotes you can get out there. Even on like Fidelity, if you go on Fidelity and you're logged in and you try to get a bond quote, it's typically from yesterday. This is only an hour delayed for free. So we have an embeddable widget. You can put it on your own website, and you can change the colors and customize it for your own needs.
the last thing I want to throw in, Jimmy, is that we do have over 1,000 people watching live, and that's really good because this is a different time than we normally, different day and a different time. And usually, Nathan, we have a lot more Q&A, but again, we're at a different time. But we do have one question here. Jimmy, why do you have a better tan than Bobby? That's from Robert. I think it's lighting. As soon as I read that, I went into my my editing software and darkened my image. But go ahead.
No, I think Ice just spent the weekend outside playing pickleball and golfing at a Michigan house that I rented. Before that, I was doing a lot of gardening. So I try to get out in the sun. I believe in the sun. I believe vitamin D is a good thing. Nathan, do you concur? Do you think, what is your health regimen, Nathan? You look healthy.
Yeah, I mean the reason I'm white is so white without a tan is because A, I don't tan that well anyway, but B, it's because I got skin cancer when I was 27, like 15 years ago. And so now I just get vitamin D from a bottle. Yeah.
Yeah. Okay. I
don't mean to laugh.
I'm sorry I asked that question.
I just like the way that was put. I'm not laughing at your skin cancer. I like the way you put that right there.
Hell no. That's funny. So Nathan, Jimmy, tell them where they can find you, and then I'll play us out.
Yeah, go to, there's deepmm.com. So deep and then M as in market, amazonmarket.com. That will redirect you to the marketing website, deepmarketmaking.com. But also, if you go to bonds.deepmm.com, that's where you can, query for any, or for most of the universe of US dollar bonds. We don't cover 100%, but we cover like 80 to 90% of the index. So most of it's there. And you can see a live 1 hour delayed price.
Did you guys just hear a beeping?
Very cool.
Hang on? Did you guys just hear a
probably
beeping?
Whatever's happening with my technology.
What's that?
Yeah.
You heard a beeping?
Yes.
I want to use that. That sounded like the fasten your seatbelts because we're landing thing. And I want to use that at the end of our shows going forward. I think it was great. Fasten your seatbelts. We're about to land.
Me too.